Let's compare retirement planning to running a race. Let's say it's the $1 million dash. From what we've been teaching you, taxed as earned investments would be like crawling towards the finish line of financial independence. Taking after-tax money and putting it into tax-deferred accounts would be like walking towards that finish line. IRAs and 401ks, it would be like jogging towards the end of the race, but you've got the wind at the back at the beginning of the race because you've got tax advantage dollars as the seed money. But on the back end, you've got the wind against you because you're having to pay tax during those golden years. Now, a Roth IRA is a step in the right direction, but I don't own a Roth because it has too many strings attached. What I do is put money into vehicles that accumulate my money tax-free. I can access it tax-free. And when I die, it blossoms and transfers tax-free. It has all the benefits of a Roth and a whole lot more. And then our wealth architects teach people how to have 4 green circles. This is sprinting towards that finish line. Folks, we've been talking about the biggest dangers that will hinder people's ability to not outlive their money are taxes, inflation, and market uncertainty. We want to eliminate those because, as we've taught, deferred taxes just mean increased taxes. I like to set aside money that is tax-free. As it accumulates, I can access it tax-free, and when I die, it blossoms. In other words, it doubles, triples, it increases in value and transfers tax-free. There are 3 types of income subject to income tax, and this has been true since 1986 tax reform. President Reagan. Still today, earned income, salaries and wages. There's passive income, rents and leases, and also portfolio income. That would be interest and dividends. When you take money out of a tax-deferred IRA or 401k, it's going to come in the form of passive or portfolio income, but it's 100% taxable. Now, people oftentimes ask, well, Doug, what do you do with your money? I set aside my money, and I've been doing this for over 4 decades, into vehicles that are not deemed earned passive or portfolio income when I take my money out. If I have that $1 million nest egg and it's generating 8 to 10%, which I've averaged for the last 40 years, that means I can pull out $80,000 a year. There is nowhere on my tax return to put it. This isn't tax evasion. The IRS knows I receive it, and they know it's tax-free because it's not one of these 3 types of income. There's nowhere on a tax return to put it. Now, this is magic, and people say, Doug, what if the IRS finds out about this? They know about it. In the risk return paradigm that I introduce in the course on Secrets to a Tax-Free Retirement, I list 16 general categories of investments from highest risk to lowest risk. And this many don't pass the liquidity test because you have to have liquidity. I want to access my money when I need it. Safety, many more don't pass the safety test. This many more don't pass the rate of return test. There's maybe 3 survivors. Out of those 3, there is only 1 that accumulates your money in the Internal Revenue Code totally tax-free, allows you to access that money totally tax-free, including the gain, and when you die, it increases in value. It blossoms and transfers tax-free, and that is a max-funded, tax-advantaged insurance contract. Now, this is the life insurance contract, and under Section 72E of the Internal Revenue Code, the money accumulates tax-free, and I've averaged 8.2% on mine for 40 years. The last 25 years, 10.07. Under Section 7702, I can access my money tax-free, and when I die, under Section 101A, it blossoms and transfers tax-free. Now, there are 3 tax citations that we are experts on, TEFRA and DEFRA. This is the Tax Equity Fiscal Responsibility Act and the Deficit Reduction Act of 1982 and 1984, and the Technical and Miscellaneous Revenue Act. This is very important that if you comply with those tax citations, your money can grow tax-free. You access it tax-free. When you die, it blossoms and transfers tax-free. It knocks the socks off of a traditional IRA or 401k. Here's the numbers. When I started in 1974, let's say I had $500,000 that I put in the market or the S&P 500. Do you know that over that time period, if I hung in there, I might have accumulated $5.6 million over that time period, ending in 2010. But that went through market volatility. What I use, you don't lose when the market goes down, but mine accumulates tax-free. I would accumulate $8 million. But here's the key. Would you rather have $8 million tax-free, or would you rather have your money in all that volatile market with heartburn, $5.6 million, and then have to pay tax on those IRAs of $1.8 million to net $3.8? What would you rather have, $8 million or $3.8 million? That's the message. Folks, so on the $1 Million Dash, instead of crawling, walking, or jogging, I would like to sprint because I can get there 50% better off than a traditional IRA or 401k.